In episode 1, I explained step 1 of the extreme trading strategy. Step 1 had to do with waiting for the price to hit statistical extremes on larger time frame intervals. Here's an example on XRP against the US dollar. You can see how the daily chart hit -3 standard deviations. Now, if you look at these red candles, you can imagine there was some momentum behind that fall. Momentum refers to the strength and speed of the price movement, indicating how likely it is that a trend will continue in the same direction. Since this is a reversal strategy, when the price hits an extreme price, I'm looking for it to reverse, to bounce off of this extreme, to reverse and move up. Therefore, I'm a buyer down here. Now, if this momentum downward does not die off, it could continue. Maybe it causes a trend. And if I bought right here and I put a stop loss, say, right down here, well, that momentum would blow through my stop loss. So step number 2 has to do with confirming a reversal has actually occurred by spotting dying momentum. This downward momentum needs to die off. So this is where multiple time frames is necessary. I need to see momentum dying off on a smaller interval and possibly reversing to the upside. So this is the daily chart, and this is that area. I'd be looking to buy as close to this as possible. If I switch over to a 1-hour chart and go back to this area, you can see that these bands, 2 standard deviations and 3, were pointing down strongly. This is downward momentum. Again, this is on a 1-hour chart. You can see how this starts to die off, and in fact it turns to the upside. So this low right here is the ultimate low for that move. Then you get a higher low and another higher low, and then it's taking off to the upside. So I would not want the market to come down below that low, because I'm going to be putting my stop loss just below here. On the 1 hour, you can see that the momentum turned to the upside, then it opens up a little bit, and ultimately starts moving up. So I will have multiple time frames up. And generally what I want to see is on some interval that is a multiple of 1 hour. It could be 1, 2, 3, 4, somewhere in there between 1 and 4 hours. I want to see the price come down and retest these bands, generally the green band. I'm not necessarily expecting it to hit an extreme low again. Somewhere around 2 standard deviations. So it's not really happening on this interval that this stays pointing up. See, it opens up here. But if I go to a 120, it's a 2-hour, you can see that this is staying closed off, meaning pointing up. It's closed off to the downside when the price comes and tests 2 standard deviations again, and then it moves up. So this is an indication to me that this downward momentum is reversing to the upside. Let's look at a 180 or a 3-hour. You can see that this, I call this a test, when it just comes and tests it and then takes off. This is pointing upward on a 3-hour. So somewhere in there, I'm looking between 1 and 4 hours for this momentum to die off, and that's how I determine it's happened. This downward momentum, signified by the slopes of 2 and 3 sigma, starts to either flatten or curve up when the price comes down, touches it, and then starts to bounce off. I don't want this low to surpass the first low, meaning I don't want it lower than here. So when I get a test, it tests this, and then it starts pushing off. That's it. That blue candle right there, that's a buy. And as the price starts moving away, you can see that this is starting to slope up now. Now the momentum has clearly reversed and is moving in the opposite direction. I won't get into targets in this particular video. I'll leave that for another one. But you can see that this entire period of consolidation is higher than this. This further confirms that the trend is now up. This starts to trend up. You can see this is channeling up, and then you get consolidation above this low, this reversal of momentum.